In this video, we're going to have a bit of a break from basic economics to have a look at incremental budgeting that a firm or a government department might do to plan and control its expenditure. In economics, history is a very valuable guide. And one thing we know about recent history is that we've had the 2008 financial crisis, which spilled over into the physical economy and impacted firm sales. And we've had the COVID emergency. So within the last 20 years, we've had two emergencies to which firms have had to respond. So budgeting at the sort of start of the year, budgeting's an ongoing process tied to the management accounting. And the idea of it is that the figures are reported to people with responsibility for them, and who can control them and who can take action. So, for example, the accountants can create a beautiful budget based on last year's figures, so-called incremental budgeting, add 5%, divide by 12, report the figures to a board. But if the expenses and the sales, when compared to budget, throw up some red flags, either sales are up, sales are down. If that doesn't call forth explanation and action, it's really just a paper exercise. So the budget really needs to be, in my experience, quite simple, so that the board and the people using it have an immediate instinctive grasp of the figures. You can get into enormous complexity with budgets, but that just simply results in delay. So-called zero-based budgeting would sort of agonize over every expense and every contract. And that really is a lower level activity, for example, in a subsidiary, where the manager has responsibility for those and control over those items. For higher level budgeting, sort of history is a valuable guide, and you start with the prior year figures. You're not having to describe the organization from scratch and its operations. You look at the past year, you add 5% to the figures, divide by 12, and that's a perfectly sensible starting point to begin your budgeting process. Yes, you then get input into the how to vary the figures. Obviously, if last year the financial result was a loss, you're not going to budget for a loss. You're going to budget for the action to increase sales, either through increased revenue, promotions, new product lines. You're not going to budget to fail. You're going to budget for success and the action that's necessary. But assuming that last year went smoothly, the firm reported at least a normal profit, and that there were no business interruptions. It's last year's a good starting point to the sort of current year activity. Sales-driven budgeting sort of anchors the financial plan, because you're projecting revenue first and scaling all expense to support those targets. Um, uh, that's a sound basis. But in general, management would hold subsidiary management to expenses strictly, so financial ratios of gross profit and so on. And the sales really is down to the drive of the individual sales and marketing departments, and the mix, what projects are on. So building our sales forecast, the operational capacity, a sort of big clue is last year's figures, in that is what the organization, with the resources it has, the labor and the factories, that's what the organization is capable of, and what it has achieved. You can use a combined method, which so-called bottom-up forecasting, multiply baseline sales by conversion rates, if you're looking at things in more detail. Top-down forecasting is quite often used in investment valuation and appraisal. For example, if you're valuing a cement works, you would tend to look at the future of that cement works in relation to the economy in which it's situated and the growth in the economy, the growth in cement sales. So that would be an example of top-down forecasting. And then historical analysis, examine the past 3 years, and within the year, identify seasonal fluctuations, varying from business to business. Seasonal fluctuations can be quite important. So secondly, you then move to dividing the financial plan into distinct expense categories to project net profit margins. So the first category would be cost of goods sold, and that into that is going your purchases and your variable labor costs. And these are various variable expenses directly tied to product or service delivery. So raw materials, production labor, packaging, fees. Sales and marketing costs, customer acquisition costs required to hit the sale forecast. So that will feature paid advertisements, sales commissions, software, marketing agency fees. Then when you would look at operating expenses, and these are the fixed overhead costs required to keep the business running. So the manager's salary, the premises, and so on. So office rent, executive salaries, insurance, legal bills. You would then look at your capital expenditures, sort of long-term investments to maintain and increase the physical assets. So manufacturing machinery, company vehicles, and sort of computer infrastructure. Financial control ratios help maintain financial health by benchmarking the budget against, for example, target ratios from the past or from the industry. Are competitors using their resources more efficiently? Are they marketing more efficiently? So the gross profit margin, if you were in a physical product business, you would probably be looking at a gross profit margin of, let's say, 33%. If you were in a business providing software or computer games or whatever, you would probably be projecting a gross margin more like 80%. So sales and marketing efficiency, at least 10% of gross revenue would be allocated to sales and marketing to maintain sales and also grow them. And the net profit margin, a baseline if it's a smaller business of 10 to 20%, after all operating expenses, tax and interest deducted. But if it's a bigger business, market share will be very important. So sort of earning a more normalized net profit, which across manufacturing businesses can be as small as 5%. But it's the old story of a profit, however small, is good news. A loss is bad news because that affects the viability of the firm. So scenario planning can help. Clearly, communication in the board is vital, and the budgeting process is all about improving communication and improving effectiveness in relation to the figures that the board are looking at and the response that the board makes. Review and variance analysis is an important part. So there's monthly variances need to be accompanied by a commentary as to why sales are 5% up while sales are 5% down. And the more work that goes into the budgeting, for example, in forecasting seasonal variations, will help that, make that exercise more viable. So the budget is a tool in the tool chest to help the calendar of the business year proceed smoothly and ensure that the resources that the business has are used efficiently, and that action to improve matters and maintain efficiency and not delay. Delay is the worst cause. So again, it's vital that these figures are reported to someone who can and will take action over them. So the financial forecasting transforms the raw historical data into some foresight, moving the business from a reactive stance to proactive operational control. And this is particularly important where businesses are proceeding by way of new and innovative projects, actually controlling the costs of those projects to within expectations is vital. So budgeting, it prevents, I wouldn't say it prevents a deficit, but it can really contribute to making sure that a deficit doesn't accumulate over the year because of action. And it also it quantifies cash flow needs, typically accompanying the budget, besides the sort of profit and loss account and the balance sheet, will be the cash flow, particularly for the company's bankers, showing the requirements over the year, and as to whether those requirements need increasing well in advance. It's usually simply too late to go to a bank with a problem. Of course, it will depend on the business. Some businesses sort of new and venture capital type businesses operate on runways. They expect to make losses for some time in order to deliver their project. So again, it's vital to budget and record those losses and those cash flows so that capital and debt is available to maintain the firm through to the project's conclusion. Budgeting also helps time expenditures, so large capital outlays can be timed to when there's surplus cash available and so on. So I hope that's helpful. I mean, typically a finance director would take last year's profit. His board's seen that, they understand it. He would add inflation, he would calculate ratios based on last year, and he would produce a budget divided across the months. And then as the results came in, he would compare the budget to the actuals and with commentary for the board, so that the board can see what action is required and what action has been taken. So I hope that's been helpful, and see you next time.